Good morning, everyone. This is Stuart. Hope you had a nice weekend. In this week's update, we'll cover the latest on artificial intelligence power investments, an opportunity for Apple to regain lost focus at its upcoming Worldwide Developers Conference, and the march higher of long-term bond yields. Starting with the story that hits close to home, Meta last Tuesday announced it signed a deal with Constellation Energy to purchase the nuclear power output at its Clinton, Illinois reactor for the next 20 years, beginning in June 2027. The deal will see Meta utilize Clinton's 1.1 gigawatts of electricity, or enough to power 800,000 homes, for a planned AI-focused data center. The contract, worth billions, is Meta's largest power deal to date. As a reminder, in December, Meta announced it was seeking proposals for as much as 4 gigawatts of new U.S. reactors over the coming years. Peer companies are also seeking to add new power capacity as rapidly as possible to support their AI ambitions. We highlight this announcement because we think the theme of AI capital investment, especially focused on power assets and data center components, is still in the early innings. We think the potential financial and productivity returns justify this investment, but do remain focused on capital discipline around AI plans. Companies ranging from independent power producers to construction services firms to the semiconductor complex stand to benefit. Sticking with the AI theme, researchers from Apple, which has had well-documented struggles with its own AI initiatives, published a curious paper last week entitled "The Illusions of Thinking." The gist of the paper is that reasoning models like ChatGPT's o3 do not actually reason at all, but hit a complexity wall as they scale and just memorize patterns really well. Now, we don't have the technical chops to opine on conclusions, but would note three things. One, if you've used reasoning models, they certainly do have impressive utility. Two, the difference between pattern recognition and reasoning is not meaningful for most users. And three, while interesting research, the fact that casting doubt on AI is the most interesting thing to come out of Apple AI thus far is disappointing. Users obviously derive functionality out of these models. We do. And it would be exciting to see Apple make actual progress in driving forward AI advances rather than just publishing critical research. Press reports indicate Apple already has difficulty recruiting top talent for its AI efforts, given its struggles and lack of focus. We're not sure such research will help in these efforts. Apple has its key summer tech event this week, with WWDC beginning 10 a.m. Pacific time today, and we hope to hear more progress about its AI implementation, including internal efforts, as well as permitting third parties like Google's Gemini or OpenAI's ChatGPT to access its iOS software to provide iPhone, iPad, and Mac users much improved AI services. The AI question mark remains the biggest headwind to the stock's performance. We think the company can work through this, but we'd prefer to see a more intense and urgent focus. Finally, the bond market continues its march higher. Better than feared economic data, such as last week's employment numbers, coupled with U.S. national debt concerns and some outflow of foreign capital, have weighed on bond market sentiment. This week, the U.S. will conduct a much-watched auction of $22 billion worth of 30-year treasuries on Thursday, which will give an indication for market demand for our long-term debt. Both 10 and 30-year treasury yields are testing two-decade highs, with the 30-year hitting as high as 5.15 last month. Perhaps we'll enjoy nominal economic growth in excess of these rate levels, and there's nothing to be concerned about. However, the longer that rates remain at these levels, the greater risk that it slows economic activity via a higher cost of capital for businesses and consumers. And eventually, that acts as a lid on valuations for risk assets, ranging from private equity to real estate to public stocks. In terms of our own bond investing, we prefer shorter-term maturities to longer-term ones. And if you're interested in discussing potential credit investments or fixed income, please let us know. Likewise, if there's anything we covered in today's video that you'd like to discuss, or if you'd like to talk about your portfolio or markets in general, please don't hesitate to reach out. Thank you very much, and have a great start to your week.